The most common investment advice you'll hear is buy low, sell high. But does that actually work? In today's video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
A couple weeks ago, I posted a video backtesting the 10 best performing stocks in the S&P 500, and overwhelmingly the number one comment I got in response to that video is what happens when you buy the worst 10 performer. We got a couple other interesting ideas, including buying the 5 worst sectors annually. So that could be an interesting strategy that we would test at some point in the future. We're going to test the strategy of buying the 10 worst performing stocks. So what were those stocks in 2023? If you were doing this strategy starting today, these are the 10 stocks that you would buy. At number 10, Albemarle was down 33%. Paycom was down 33.4%. Etsy was down 34%. This is unfortunately a stock that I bought in the coffee can portfolio for the last update that I did at the end of 2023. If you're interested, I'll put a link in the description down below, and you can check that out over on Patreon. At number 7, we have Estee Lauder down 40.6%. Pfizer got off of its COVID sugar rush and was down 41.4%. Moderna, same thing, down 44.4% off the major COVID sugar rush that drove the stock price higher, and now it's basically collapsed back down to pre-COVID levels. Dollar General down 44.4%. FMC Corp down 48.1%. Enphase Energy down over 50%. And the worst performing stock in the S&P 500, SolarEdge Technologies, fell 66.7%. So what would happen if you bought these 10 stocks and held them in 2024, and then at the end of 2024, you sold all of those and bought the 10 worst performing stocks of 2024? That's what I sought to find out. So we started with the S&P 500 index, and we equal weighted the 10 worst performing stocks over the prior 12 months, each one of those positions starting at a 10% weighting. I also rebalanced this portfolio annually on January 1st. And we went all the way back to 2003, going all the way through 2024, or at least as much data as we had. As I filmed this video, we're in January of 24. All dividends and other cash that came in the account, maybe from a stock that got sold to a competitor who bought it with cash, all of that will get reinvested at the rebalance. And then the benchmark that we're going to be comparing this strategy to is the S&P 500. So if we go back all the way to January 1st, 2023, and we measure the worst performing stocks over the prior 12 months, these would have been the worst performers. You'll notice there are several tickers that look kind of strange. They have these little carrots. All of these are ticker symbols for companies that do not exist anymore. They were either purchased by another business or they went out of business entirely. Anytime you're looking at backtested data, you want to make sure the backtest is not using the current S&P 500 going back to 2003, because there are many companies that existed back then that do not exist now. And there are many companies that are in the S&P 500 now that performed exceptionally well that you would not have known about in 2003. So you want to always make sure you're using what's called point-in-time data. If you want to know more about how I ensure that the data that I'm using is point in time, and the specific tool that I use to run these backtests, I'll put a link in the description down below. I'll also link a video I did for my Patreon and YouTube supporters talking about the exact process that I follow in the software that I use, which is Portfolio 123. If you sign up in the description down below, you'll get a 35-day free trial to Portfolio 123. I'll also put a link to my Patreon. If you want to sign up to support me, there's a 7-day free trial. You will get access to my Financial Freedom Formula course, which I typically sell for $189. So hopefully this will add a ton of value to your life. So back to the back test. So we bought these 10 stocks on 1/1/2023. That would have been the next trading day. So you can see all of these stocks were purchased. Interestingly enough, Nvidia was one of the worst performing stocks at the end of 03. And now, of course, it is one of the best performing stocks this year. So we would have bought all of these stocks, put $10,000 in each one, and then held those through 2023 all the way to the beginning of 2004. So if we flash forward to the beginning of 2004, This would have been the new stocks that we purchased, these 10 stocks. These were the worst performers as of January 1st, 2004. Now let's check in and see how this strategy would have performed over time. This is showing the results for the prior 10 years as of January 4th, 2024. So basically this is from 2014 to 2024. I'll show the full results here in just a second, but there's some interesting data here. The first of which is this annual performance. So we can see how the strategy actually did each year in the last decade. And what we really want to see is this excess return. So this takes whatever the strategy produced and subtracts the benchmark performance, which again, this is the S&P 500 index, and tells us whether this strategy outperformed. So outperformance is in these positive numbers. So in 2016, this strategy outperformed by 48%. So it was up 59.9. The S&P was only up 12. So this was a fantastic year for this strategy. But if we look on the other end, the year before, it was negative 37.1. So while the S&P was up slightly 1.2%, this strategy would have been down 35.9. But as a whole, as you can see here by the growth of $10,000, this strategy grew $10,000 to $18,802, whereas the S&P 500 grew it to $30,314. We also see the risk metrics. So we have beta. This strategy was 1.71. So it produced more risk relative to the S&P 500. Sharpe ratio, which is a risk adjusted return metric, was lower. Sortino ratio was also lower. Standard deviation was more than twice as high. Downside deviation was also twice as high. And then the maximum drawdown for this strategy was 83.4% compared with 55% for the S&P. And if we look at the year-to-date, 1 year, 3 year, 5 year, 10 year, and since inception numbers, we see that the strategy only outperformed in the 3-year period. And actually, if you go back to inception, it slightly outperformed by 0.1%. However, it did so with dramatically more volatility. And you can see that with this chart. So the strategy that bought the 10 worst performers is in red. The S&P is in blue. And you can see these extreme ups and downs in the strategy. Sometimes it outperforms massively, but then it has a lot of crash risk. I don't know anyone that could stomach an 83.4% drawdown and maintain the strategy. The other thing is this is extremely tax inefficient and also has a lot of trading costs involved. The turnover is over 100% per year. Basically, you're selling everything. So is this a strategy that I would consider for my own personal accounts? Well, if it's not obvious enough already, the answer to that would be a resounding no. I would summarize this strategy as bad, awful, terrible. There is I think one possible use case for this strategy, and I think it's to illustrate how bad of an idea it is to buy low based only on price. So many people think that buying a good value means looking at a chart and buying a stock that's at its 52-week low, or a stock that's fallen in price over the last month or year or even 5 years. That does not indicate value. A value is a company where the current price is less than the intrinsic value of the stock in the future. So if you have a company where the fundamentals of that business are eroding steadily over time, the price for that stock is going to be falling, and it should be, because the intrinsic value of the business is going lower over time, not higher. Conversely, a company whose stock price is going up, up, up each and every year is not necessarily getting too high. That could be the case, or it could be that the fundamental value of the business is steadily increasing over time. So if you watched both this video and the back test where we bought the 10 best performing stocks, you'll notice that the 10 best performing stocks, while still a risky strategy, did substantially better than the 10 worst performing stocks. So generally, it's a better idea to buy the best performers than it is to buy the worst performers. And that's because in most cases, the fundamental value of the best performers is increasing over time, or at least it did over the prior 12 months, which indicates that it's more likely to do that in the future than the stocks that are on the worst performer list. Of course, there are always exceptions. We saw Nvidia was in the worst performing list in 2003. So if you would have bought that in 2003 and just held on to it the entire time, you would have made an absolute fortune. Actually, in the video I did on Patreon, I did a little bit of a coffee can spin on the worst performing strategy, and we found some shocking results from the 2003 example where we did buy NVIDIA and hold it the entire time. It's a pretty amazing little illustration. But anyways, that wraps up this video. What did you think? Was this surprising to you? Were you surprised that buying the worst performing stocks performed this badly? Any other ideas you have for back tests, let me know in the comment section down below. Thanks again to everyone who is supporting me on YouTube and Patreon. Really appreciate that support, and I will look forward to seeing you in the next video.